So we can use the discussion so far to think a bit more about the reasons why financial crisis occurs. So we are going to be looking at multiple examples, some from developing countries' perspectives and some from more advanced economies' perspectives. So let us first think about the interlinkages between developing countries and advanced economies. And we are going to be starting the story from our discussion of international capital markets. So one thing that people have observed is that since 1980s, macroeconomic problems originating from developing countries have become an important factor in the stability of the international capital markets that we have been studying. So what happened is that after World War II, trade along with the financial transactions between developing and industrial countries expanded. So we saw a bit of the reasons why that was the case in our previous segment. And more extensive links between these two groups have made each group more dependent than before on the economic health of the other, right? So what that means is that earlier a financial crisis, for example, in a developing country would just remain in a developing country. But now, because of these interlinkages between advanced economies and developing countries through these different global markets, now any problem in a developing country may actually also impact the larger global economy, right? So it's important to understand what are the macroeconomic problems that happens in developing countries and what is the effect that these macroeconomic problems actually have on the international system that we have been looking at. So most developing countries have actually a few features in common. So for example, there are typically poor in factors of production, which are essential for modern industry, right? So think about capital, which would mean the advanced machinery that is required to produce things, as well as the skilled labor that is important for modern production. So typically, the developing countries often lack these important essential factors of production, right? And as a result of lacking these essential factors of production, that essentially leads to low levels of per capita income. Now, this is just asking an additional question, right? Why is it the case that these developing countries are lacking these essential factors of production? So they actually are a symptom of an underlying deeper problem. So typically these deeper problems are, for instance, linked to political instability or property rights not being very secure, right? So if you have like a weak legal system, that would lead to insecure property rights, as well as if you have government policies which are inefficient and misguided, right? So if that is the case, then there is low incentive for different entities to invest in developing these factories and advanced machineries that is required for modern production, or there would be low incentives for people to actually invest in skills so as to become more productive, right? So these problems are kind of interlinked. Okay. And the other thing to observe is that there's typically very large differences in the long run growth rates among different regions in the world, right? So, for instance, if you look at sub-Saharan Africa or several Latin American countries, the growth rate there has been relatively slow. Whereas if we look at East Asian economies, they have tended to actually grow at rates which are even higher than the advanced economies, right? So if especially if we look at the period beginning from 1960s onwards, right? So what as a result of these different heterogeneous growth rates, one thing that we observe is that compared to, let's say, 1960s, the poorer economies now account for a much bigger share of global income compared to the past. So in 1960s, United States and the other advanced economies made up for most of the total GDP of the world. But by 2000s, rich countries were explaining less than half of it, right? So now you have got these poorer countries, which are making up for a larger share compared to before, right? So what that tells you is that you have got this emerging and developing countries have actually in the last 50 years tended to grow much faster than the advanced countries. And also what you had is that in the advanced economies, growth actually slowed down compared to the 1960s, right? So as a result of this, the share in the total global GDP has gone up for this emerging and developing countries, right? Now, when we say developing countries, we actually should be aware that not all developing countries are the same. So there is a wide difference between the developing countries now compared to before. So in the 1960s, the situation was a bit different in the sense that these developing countries were much similar. However, after that, you had these East Asian countries, among them South Korea, for instance, which switched to a more export-oriented development strategy instead of just focusing on internal uh, needs of the country, right? And these strategies actually ended up proving to be quite successful, right? So you have a lot of these different countries, South Korea again being the most prominent example, but you can think of Vietnam, Singapore, and a lot of different countries, which actually ended up becoming quite rich, right? You also had a lot of changes happening in Latin American countries. So these are countries which are in Central America and South America, uh, who reduced the trade barriers, so allowed for more import and export of different goods, right? They also opened up their international financial transactions, so they allowed for actually private parties to invest in their economies and so on. And they reduced the government role in the economy as well. So as a result of these reforms, there were lower inflation compared to before. However, it did not have as much an impact on growth as did the East Asian economies had, right? So you can see that there were differences in terms of outcomes, right? Now, having said that, these developing countries are not all the same in the sense that you have got different outcomes happening in different places. Uh, it's still the case that developing countries tend to have some common features, right? So let us look at what some of these common features are. So you have got typically a long history of extensive direct government control of the economy. So this direct government control actually works out in different ways. So you would often see in developing countries that there are often restrictions on international trade, and large industrial firms are often under government control and ownership. And government often intervenes much more on international financial transactions. And typically, if you look at the GDP composition, you would see that there is often a large share of government expenditures in part of this GDP, right? So again, another common feature among these developing countries is that there is typically a history of high inflation. And this is often because governments often resorted to actually printing money there to fund expenditure in these developing countries. Uh, then you might have situations where you would have that in a lot of these countries, even though the domestic financial markets have been liberalized, in the sense that it's not just that you have got government-sponsored banks operating, uh, but still, even though there is liberalization in these financial markets, you would have that the credit institutions are still weak, right? In the sense that there are problems in the way in which banks decide who to give money to, and there's often poor government supervision of this banking system. Then another feature which is common among developing countries is that you have thought that exchange rates are managed more heavily by developing country governments, in the sense that you would have governments often intervening to, for example, keep the exchange rate high and so, right? Uh, Another feature that is common and that adds often to instability in developing countries is that you have got natural resources, which make up a very important share of the exports for many developing countries. And we'll see that the reason why this adds to instability in developing countries is that that often these natural resources are subject to external shocks, right? So you have got these big swings in the prices of these natural resources, and as a result of that, you might have big changes in the amount of money that is available to these developing countries, right? And another feature that is often common in these developing countries is that you have got attempts to get around the government controls, taxes and regulations, and that have led to development of informal sector as well as corruption in the economy, right? So these are typically features which are quite common across South Asian countries as well as countries in Africa and Latin America, right? Okay, so let's look at an example of why this commodities and this dependence of natural resources can not necessarily be a good thing. So, for instance, between 1998 and 2020, the aggregate commodity prices have experienced a boom bust cycle, right? So, what does that mean? This means that if we are looking at the prices of different commodities and we are adding them up. So what we would observe if we were to create an index out of such commodity prices, we actually would have observed that during this period, for a certain time, the prices of different commodities actually ended up rising by more than 400%. Then that was followed by a sharp fall during the Great Recession. So this is the global financial crisis and its aftermath that we have discussed before. And after that, again, there was a fall of 50% from between 2011 and 16, right? So if we were to look at this figure, so this is an index such that the price of this index has been normalized to 100 in 2016. Okay, sorry, this should be in 1998. And starting from 1998, what we observe is that the prices actually first rose, right? Remember, we said that the prices rose by 400% initially, right? So this is prices which was normalized again at 1998 to 100. So prices rose from 100 to 400. Then you see that there is a fall. So this period corresponds to the global financial crisis, right? Then it recovered somewhat. But then again, it ended up kind of like falling by 50%, right? So you had it around to be 400. And then by 2020, you can see that this is around 200, right? So this is the fall of 50% that's mentioned here. Okay, so what are these commodities that we are talking about? So these are things such as fuel, such as oil, coal, and natural gas. It includes metals such as aluminum, iron, and tin, and also it includes food items such as corn, rice, and wheat, right? So this index that we are talking about, this you can think of is a combination of these different entities, okay? So what explains first the huge rise and then the fall that we see here? Well, first remember, if you see from here, the prices were typically rising from this 1998 onwards. So there was this fall around the global financial crisis, but then again, it recovered almost back to its peak, right? So what explained this period where from, let's say, roughly 1998 to 2011, you had this rise, right? So there were several things that were going on here. So important determinant of this rise was the growth in emerging economies, especially China. Well, why is this going to lead to increase in the commodity prices? Because there was demand coming in from China for these products. And as a result of this, you had this increase in prices of these products, right? You also had at the same time supply constraints, so a reduction in supply due to droughts in important agricultural regions. And also you had the political turmoil in the oil producing countries, right? So think of the different wars that took place in the Middle East. Then you also had the Arab Spring and so on, which are taking place at this time, right? So all of these things led to reduction in supply, and we know that reduction in supply typically leads to an increase in prices. The other thing that happened from from an international finance perspective, is that this period was also characterized by low interest rates in the advanced economies, and that led to actually investors looking for opportunities to invest in different alternative assets. And one of the opportunities that the investors utilized at this point was actually investing in these commodity stockpiles, right? And as a result of this, that also led to higher commodity prices, right? So this is the phenomena that is going on till 2011. And after 2011, we see that there is this reduction that starts taking place, right? So what happened after 2011? So firstly, remember, China was one of the important determinants behind the rise of this price of commodities. But China actually started changing its strategy after 2011, right? So initially, the focus was on investment activities. So in the sense of building different kind of like productive factories, machineries, highways, and so on. And then the focus started shifting towards more about domestic consumption, right? Particularly of services. So as a result of this, a lot of this demand for these metals and so on, that actually reduced from China. And this reduction of demand would lead to a reduction in price, right? You also had a reduction in the world price of oil because of the slowing world growth rate, right? So if the growth rate of the world is slower, then there is less demand for oil, and that is going to lead to a reduction in price. And there was also actually price wars taking place between these oil producers, right? So again, as a result of this, you had oil producers competing by deciding to increase their supply and reduce the price. And that is again something that led to a reduction in the price of oil, which was one of the items in this index, right? And the important thing is that this commodity price decline ended up actually leading to slower growth to commodity exporting emerging countries, right? So remember, one of the things that we studied in terms of like developing countries is that these natural resources often make up an important share of exports for many of these developing countries. So if the prices of these natural resources actually and tends up going down, so then that would hit this emerging economies, right? So particularly countries in Africa were particularly badly hit when you had this commodity price actually slowing down, right? So if you are considering the financial condition of these countries, it's important to be aware of the developments that takes place in the commodity markets. Okay. Now, the other important thing that we need to think about when we are thinking of developing countries is that they often rely on financial inflows from abroad to finance domestic investment. Again, what is domestic investment? So this is building up of infrastructure, factories, machineries, and so on for production, right? Now, this is not just true of developing countries that they have historically relied on financial inflows from abroad. This has also been true about countries which are now considered as developed or advanced economies, right? So think about the United States in the 19th century or Australia, Canada, and so on. So countries which were still developing then, they also actually relied on money from abroad to finance these activities, right? Now, what happened is that in the decades after World War II, so this is the period where this international capital market that we have been discussing was building up. So you had that developing countries resorted to savings of these richer countries, and they tended up to build up very high levels of debt, right? So this debt amounted to, for instance, $11 trillion in 2020, right? Now, this developing country debt was actually a very important determinant of several international financial crises that started in early 1980s. So we want to understand a bit more of how such financial crisis works. And in order to understand that, let's understand what exactly is the reason why these countries take up debt and why can it sometimes lead to bad outcomes, right? Okay. So why are these countries resorting to borrowing from abroad? Because the amount of savings that are available domestically, that typically is often falls short of the investment that these countries are interested in making, right? And if you have got the national savings falling short of domestic investment, then we are going to say that that difference between this national savings and domestic investment, that is basically the current account deficit, okay? Now, why do the national savings often fall short of the amount of money that these countries are interested in using up for building infrastructure and machinery and so on? Well, the savings are often low in developing countries typically because you have got the income being low and savings is just a fraction of the income, right? So if income is low, then savings are also likely to be low. And so that's why you have got that the savings are low, right? Now, why is the investment requirement more than the savings? Well, because you have got these countries which are poor in terms of the capital stock that are available. So there actually exists a lot of opportunities for introducing new plants, factories, and so on, right? Because you would imagine that in a place where you do not have such plants, factories, perhaps building one would lead to high returns, right? So because of this potential for high returns, you have often got other people from abroad, for instance, who might be interested in actually investing money there because there's this promise of potentially high earning a high return, right? Now, by running a current account deficit, so a situation where you have got the domestic investment being more than the savings, then a country can often obtain resources from abroad to invest, right? So that's the reason why a country might be interested in running this current account deficit, right? So what does a deficit in current account mean? It means that the country is borrowing abroad, right? And as a result of that, the country is actually able to import more foreign goods today than what its export can pay for, right? Now, of course, this is not coming for free. And what it means is that either the country in exchange has to promise to pay both the principal as well as interest on this principal on the loans that they have taken, or they have to end up actually giving ownership to foreigners in the different domestic firms, and then they have to actually pay dividends on the shares on this, right? So this is how they are actually for funding different investment activities. Now, when you have got that these developing countries are borrowing to undertake investments that they would not be able to carry out, in principle, both the borrower and the lenders are benefiting from this trade, right? Why is that the case? Because the borrowers benefit because they are able to build up this capital stock. So this investment in infrastructure, machinery, factories, and so on, despite having limited domestic savings, right? So if they did not have the opportunity to borrow abroad, then they would not be able to build this new factories, build up the infrastructure, and so on, right? How do the lenders gain? Well, because they're earning a higher returns on their savings than what they would have been earning in their domestic economies, right? So because there are these more opportunities for money and potentially more low-hanging fruits, this is an opportunity for the lenders to also gain, right? But these are things that work only if, of course, the investment is being made in a sound way, right? So if, on the other hand, you have got that the loans that are being given by developed to developing countries are not productive, but are being used on things that are of not going to be of much value. So think about huge shopping malls that are built that are not occupied by shops at all. So you have got just these empty buildings, or that these are being used just to actually finance spending of on imports of consumption goods. So goods which are just good for consuming today, but do not add to the productive capacity of the economy, then they actually may end up in a situation where you have got an increase in debt, and in the future, these debts are not going to be able to be repaid, right? Remember, it's not just that the money that you are taken that you have to repay, but you have to also repay the interest on that debt, right? So in order to do that, you have to make sure that the money is actually sound, in the sense that the investments that you have made are actually going to lead to an increase in the return that you are getting, right? So all of these things, these benefits that we mentioned here, they rely on the investments being actually sound and all these things, right? Okay. So an important prerequisite for this borrowing from this that these developing countries are doing from developed countries is that the lenders must be confident that they will be repaid, right? Now, what happens if the borrowers are not able to repay? So then we are in a situation of default, right? And in that situation, the borrower basically, without the agreement of the lender, fails to repay as per the schedule of the loan contract, right? Now, this is the source of risk, right? When you have got this borrowing from this developed economies to developing economies, right? And the social and political stability, or rather the instability in these countries, often make it more risky to actually to lend to these countries, right? And there are quite a few examples historically where actually you had countries taking out loans from other countries, and then they were unable to pay back, right? So there are like several recent examples, in fact, in South Asia, right? But historically, of course, a lot of countries which are now advanced are also have been involved in default, right? So, for example, in the early 19th century, you have got few states in the United States which defaulted on loans taken out from Europe to finance infrastructure. Then again, in the 20th century, in 1917, the new communist government of Russia had defaulted on foreign debts which were incurred by the previous rulers of Russia. And as examples from this century, you have got Argentina, who have often defaulted or either restructured their foreign debts multiple times, right? So restructured basically means that they were unable to pay back, and then they entered in a negotiation saying that, okay, we cannot pay back these things, right? Again, something, for example, that we have seen in South Asia recently as well, right? So Sri Lanka a few years back. Okay, so what happens after you have got this default? Well, the country ends up actually losing access to this foreign source of funds, right? Because if the people who have lent money to these countries become concerned that these countries are unable to pay back, then you have basically got a situation where they would obviously not want to give further money to these countries, right? And as a result of this, you have got often a sharp contraction in output and employment that happens, right? And this phenomena in which country loses access to foreign sources of funding, this is the sudden stop that happens, right? Okay, so foreign lenders, they not only do they withdraw new loans, so they're not willing to give further new loans to these countries, but they often actually end up asking not only for the repayment of the loan on which default happened, but they are actually asking for repayment of all loans that they have given to these countries or to the entities in these countries, right? And larger the country's short-term foreign debt you have, so larger is going to be the effect of reduction in investment and all these things that is required to service this loan, right? So if you want to avoid the default, and if you have got borrowers who are asking for money, you have to figure out ways of repaying them back. And that would either be leading to a larger increase in savings, right? Which would be bad for the economy potentially in the short run, or it would lead to a compression of the investment that you were making, right? Again, which has adverse consequences for this, right? So this developing country sudden stops, so this phenomena that we have talked about, and default crises can often be driven by a self-fulfilling mechanism. So this is similar to the bank run discussion that we had, in the sense that if suddenly investors become worried that the country would be unable to pay back the loans that they have taken, right? Even though there may not be anything fundamentally wrong with the country, then you enter into a situation where they ask for a loan to be repaid immediately. And then as a result of that, the country actually ends up being in a trouble, right? So it's self-fulfilling in the sense that if there is a fear that this country is unable to repay back, that at itself can actually lead to a situation where the country becomes unable to repay back, right? So this same phenomena actually takes place in various currency crises, default crises, bank runs, and so on, right? Okay, so you have got, as a result of these default crises, at the same time, several crises starts breaking out in these economies, right? So you have got, for instance, bank runs that also happen at the same time, and balance of payments crises also happen, right? So what do we mean by balance of payments crises? So these are crises which occur because the country's official foreign exchange reserves may not be sufficient to maintain, for instance, the imports that they were doing, right? Why is that the case? Because oftentimes these foreign exchange reserves may be the only means that are possible to pay back the short-term debt that these that these lenders are recalling, right? So if that is the only way of kind of repaying back, then your foreign exchange reserves are now going to be used up to pay these things, and so they would not be available for the imports that you were doing, right? So this running down this foreign exchange reserve may be one option that is available to the governments to reduce the effect of this demand that we discussed, right? But that also has a cost, right? So either the cost is going to be that it becomes harder to purchase the imports, or it may be because it may comes harder to actually support the exchange rate at whatever the rate the government had decided on before, right? So this thing actually has adverse effects on the government's foreign economy policy, right? Okay. Why are banks in trouble? Because if you have got then the foreign exchange rate actually being affected as well, then there is a fear among the debtors, and these are both domestic and foreign debtors, who worry that there's going to be a currency depreciation, and there are these consequences of this default. And as a result of that, they start withdrawing the funds, right? And as a result of large scale withdrawing of funds, that can lead to bank failures, as we have discussed before. And there can also be negative impact on government public finance in the sense of government spending, because then the government would need to also kind of bail out the banks, right? So they would have less money available to actually spend on other social expenditures such as health, education, and so on, because they would need the money to actually bail out the banks, right? So you can have this sort of financial crisis playing out, and the origin can be in different places, right? So it can be either in a financial account when you had the initial problem being a default. It can be in the foreign exchange market, or it can be in the banking system. So when you have got a government defaulting on the obligation rather than a single private player defaulting on the obligation, this event is often referred to as a sovereign default, right? So sovereign comes from the government, right? Okay. So this is actually different from a situation when you have got private domestic buyers being unable to pay back their debt to foreigners. Uh, However, these type of things often happen together, right? So they were relatively rare in the decades after World War II, but they picked up starting in 1980s. And this is one phenomena we'll discuss in detail later on, right? Now, to understand the reason why you have such default and the story that we are going to talk about, this Latin American debt crisis in the 1980s, is that one thing that we need to understand is that whenever you have got these developing countries borrowing from foreigners, often this debt is in terms of actually foreign currency, right? So it's not the case that you have got that you are actually saying that you are borrowing, let's say, X amount of rupees from this entities. It's often that you are borrowing, let's say, X amount of dollars or X amount of euros, right? Now, why is that the case? Because the lenders from these richer countries, they often fear extreme devaluations and inflations in these developing economies, and therefore they insist that these developing economies must repay them back in these lenders' own currencies, right? Now, why is that important? Because if the loans were in domestic currencies, one way out would be, for example, to just print the currency and repay the creditors, right? Now, that has adverse consequences in terms of inflation and so on, but at least it would avoid the default problem, right? So then there would not be any need to default. But if the loans are in terms of foreign currencies, then you cannot just print and then use that to repay back the currency, right? So what is the phrase original sin that you often hear in this context? So the original sin refers to the fact that the developing countries are unable to borrow in their own currencies, right? Because of the reason that we just talked about. And as a result of that, are forced to borrow in terms of foreign currencies. And that itself can lead to, as we'll see, a source of financial instability in the system, right? So whenever you have got depreciation of the domestic currency, that's actually going to reach to transfer of wealth to foreigners by raising the amount of money that has to be paid to service the debt. So that is the context of this debt crisis of 1980s. So what happened is that in 1981 to 1983, the world economy actually ended up in a sharp recession, right? And the origin was basically in terms of the US economic policy, where in the 1970s, there had been large inflation. And in order to control that inflation, the US had decided to increase the interest rate, tame the inflation, right? So this had like several adverse effects. So one adverse effect, for example, was that because you have this recession, so there was less demand on products from these developing countries, and that led to a fall in the prices and so on. So a fall in demand led to a reduction in the amount of income that these developing countries were getting. But there was this another effect that was happening. So a lot of the loans that these developing countries had taken out was denominated in terms of dollar, right? And once you had the dollar also actually appreciating, so that led to actually also higher interest rates that these countries now had to pay to the to service the loans, right? So two additional things that happen. You have got this primary commodity prices collapsing because of the recession, right? So that anyway reduces the ability to repay back these loans. But then you also had these loans were denominated in terms of dollar, and the dollar's sharp appreciation raised the amount of money that these countries had to pay in order to service these loans, right? So as a result of both of these things, you had now kind of like countries starting to actually think about saying that, okay, uh, there is this an inability to potentially meet the payment on foreign debt, right? So the crisis actually began in 1982 in Mexico. where the country announced that there was no longer enough foreign reserves in order to meet payments on this foreign debt, right? So as a result of this, the banks in the industrial countries, they responded by reducing their risk by cutting off new loans that they were supposed to give, right? And they started demanding repayment on earlier loans, not only in Mexico, but also in other countries in which they started to fear that these countries may also default, right? So in other Latin American countries such as Argentina, Brazil, and Chile, they also started asking for repayment, right? And as a result of that, we ended up in this financial crisis situation where there was basically a widespread inability of these developing countries to meet the prior debt obligations that they have taken up, right? So not only did you have this problem in the Latin American countries, but the problem also spread to other countries which had borrowed from these European banks, right? So once you have got a fear of this default taking place, and you're worried that a certain part of the loans that you had extended are going to turn bad, you start also thinking about the other loans that you have given out. And then you start also recalling those other loans before they are also in problem, right? So these European banks, which may have been kind of like extending it to different places, like loans in this Latin American countries, they would also be kind of like in a troubled situation. Plus, you had also this factors which were affecting these Latin American countries also playing out in Poland, right? So as a result of that, these countries were also hit, right? And it's not just now Poland, but it's also other countries such as African countries which had borrowed from official agencies such as IMF and World Bank, which had trouble repaying their debts, right? Remember, there were two sources of problem, right? One was that you had this commodity prices collapsing because of the recession, but you also had this dollars up appreciation that also was leading to a problem, right? So by end of 1986, you ended up with a situation where you had more than 40 countries which had problems in terms of servicing these loans or loans no longer being extended to them, right? And as a result of this, the borrowing in developing countries had decreased a lot. And remember, this borrowing was often used to fund this infrastructure building and this developing of capital and so on. And that, because that also was affected, you had this growth in these developing countries also being adversely affected, right? Now, this was not just a problem for developing countries, right? It was also a problem for advanced economies. And the reason is very simple, right? Because you have got these banks in these advanced economies which are lending to these different players, right? Now, if these assets actually turn out to be bad, so the assets being the loans that they have extended, they turn up to be bad, then this is going to lead to a shrinking of these large banks' balance sheets as well, right? And they would either be forced to declare bankruptcy or they would be forced to reduce the amount of loans that they are extending in the economy because of the different mechanisms we have talked about, right? So policymakers started fearing that you have got these major banking units which are based in the US, such as the Citicorp or the Bank of America, which had significant exposure to these banks. They would also fail if a generalized default occurred, right? And this would not only be a problem for these developing economies, but would now be a problem on this global financial system that we have, right? So how did the crisis eventually end? Well, in 1989, United States, which had been fearing political instability, basically asked these American banks to either renegotiate or give more time for this repayment of debt. And basically, for instance, in 1990, the banks agreed to reduce Mexico's debt by 12%, right? Remember, Mexico was the country which started this whole crisis, right? So why is like reducing the debt by 12% actually worked out? Because this is basically saying that now, okay, you don't have to no longer kind of like focus on repaying back as much of the loan as was due before. And maybe this is something that is actually kind of like feasible to be paid back by Mexico, right? And in the end, similar agreements were negotiated by these other Latin American countries, which were also in problem. And that eventually led to the reduction in crisis. So that is how the debt crisis of the 1980s played out. Now, this was an example in from a developing economy perspective, like what are the sort of financial crisis plays out and what are the different linkages between the different types of crisis that plays out. We'll see now examples of also different types of financial crises that can occur in, let's say, more of advanced economies context.